Hey everyone, welcome back to Yuri's Box. In this video, I'm going to be answering, again, comments from the comment section, as well as talk about gold and the dollar. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, if you have anything to say in the comment, do comment. And if it is, if I feel like making a video on it, I'll consider making a video on it, as I have been. So I'll start from the second question. You traded crypto, I majority in stocks or crypto. Well, I can tell you I do not own any crypto and I don't own any stocks. I've been hiding out in the safety of the treasury market as long as it remains safe ever since. And I mentioned this in one of my first videos. I didn't really talk about it after that. Again, I really shifted to risk off in May, from May to July, basically because I started seeing some of the increased signs that we were heading towards a rough patch in the growth side of the equation. And also, I remember just reading some company reports from the mostly consumer-facing companies like McDonald's or Starbucks. Nothing going into too much detail, but whenever they say things like that, they're offering discounted meals, or they're trying to bring back people because people can't afford it. And we're talking about McDonald's here. You gotta kind of raise a red flag at least, all right? So, and again, I'm definitely guilty of being on the bearish side. I mean, I was one of the schmucks again, as I said in many of my previous videos that were calling for a recession in 2022 and 2023. I mean, right here. And again, to my defense, I was just starting out. I mean, I really didn't know anything. If going back, I definitely would not have been calling for a recession, given the fact that a recession at this point was consensus. And that is one of the first things I learned, really, is that if something is consensus, it's usually wrong. And even if it's right, it's usually priced in at that point. So it's never worth it to be on the side of consensus. So again, that's the way I currently am positioned, meaning I'm risk off. And again, I'm hiding out in the treasury market, and basically, I only go with the best. That is my my philosophy with whatever it is, meaning stocks. I stick with US stocks. Why? Because they're the best in the world. I would never hide out in Europe, mainly because Europe prioritizes quality of life over productivity. Well, I mean, and if you want to, and I can vouch for that. Again, I live in Europe. If you want to have a healthy meal, come to Europe. If you want a healthy portfolio, go take your money to the US. That's my view. And again, that's the way I go about things. Okay, so it kind of answers the second part of the question. And again, just briefly touch on crypto. I've spoken about crypto and what I think about how I feel about crypto. Where are you? Here. Again, this move, I mean, today's move, we have a 4.5% yearly move on Bitcoin. I would still be on the cautious side when it comes to Bitcoin. And again, I'm the first to say I'm admittedly on the bearish side, and Bitcoin is definitely stronger than my bearishness. All right, I mean, we could easily be above, as I've always said in my previous videos. I still have the the text from them. We could easily be at 120K. Why? Because that's what Bitcoin does. All right. If I had to just give you a little tidbit, I would say that this move, what bugs me about this move is that it's eerily similar to what we saw in 2019. Now, percentage-wise, this move right here is identical. If I'm not mistaken, this move right here is roughly double the breakout we saw in 2019. Excuse me. Meaning, and by breakout, I mean this secondary bump right here. And I've talked about it in my previous videos. And again, I could definitely be wrong. This could be the exact opposite of 2019. But we still are in a regime of higher rates and quantitative tightening, which is what we had in 2019. And again, I'm still cautious on Bitcoin because usually when you have a transition from QT to QE, it's at the expense of growth. And that is why I'm hiding in the treasury market, right? That's kind of the coherent thought behind it. But again, Bitcoin is definitely stronger than my bearishness. I'll leave it at that. To answer the first part of the question, could we see a massive reversal in the bond yield and dollar price when trade deals get done? Now, definitely. I mean, I think that today we got a kind of a sneak peek of that. Mainly because, you got Bessent kind of got leaked that, he had a talk with JP Morgan yesterday. And, he said that the situation with China is unsustainable, which isn't entirely untrue. And after that, we had, speculation that perhaps we are very close to a deal with Japan and India and Korea and South Korea. Again, I wouldn't get my hopes up too much because again, it is still talk. I mean, it's where are the deals? All right, that is basic. Where's the beef? We keep hearing the talk of great deals being done, but we don't see the deals yet. So. But again, just to come back to the point, we did see today a possible positive reaction to that, to the possibility of trade deals getting struck with maybe a bounce in risk assets. That's one way you could square things around. However, I will defer to my videos that I made yesterday and earlier today, meaning that the way I'm going about this after really it was last week, I think, when Trump walked back the tariffs, when he excluded semiconductors and electronics basically from the tariffs. Ever since then, I'm basically shifted. Right? What I've been saying is that it's game over at that point. We've walked away from the maximalist approach, and because of that, we will slowly have to shift back to watching the economy. And I do believe that we are still in a state where we are ignoring the economy and we're potentially a little bit complacent about the state of the economy. We continue to operate under the assumption that the economy is strong and resilient. When we have, and I've spoken many, many times about this, we have a lot of signs that hint towards the economy being weaker, not just because of tariffs, not just because of Trump, but potentially starting, potentially last summer. And actually that September to January strength was probably due to transitory events. And again, I use a T word, knowing full well the risks connected to the T word. And again, those transitory events probably made the economy look better. It was kind of like putting pigs on pigs. Lipstick on a pig. And again, made growth look better and inflation look worse. And my assumption, ever since I started making videos, is that potentially we would see the opposite, meaning more growth concerns and less inflation concerns. Which leads me to the point of the video, really. Thinking about going back to the fundamentals of the economy, and again, I'm operating on the assumption that we will. I might be early, but I do believe that we'll be forced to look back at the fundamentals of the economy. And rather than being trade deals, I think it will be the fundamentals of the economy that will get the attention of the markets. And meaning, if we do see bond yields go down and dollar reverse, it would be at the expense of growth. And I do believe that either way, we're going to get trade deals. I mean, I don't buy in the the doomsday scenario that these tariffs are going to stay on forever. I went into this thinking that trade deal, maximalist approach would be, a tool for negotiations, and that's how I remain. Now, are they being done in the best way possible? Absolutely not. But that's the way I'm going about it. Two things. All right, so to further elaborate on that, what could cause the dollar to reverse? Well, this is kind of a trade idea, if you will. Tomorrow has the possibility of being a news failure event. What is a news failure? Well, you basically get a piece of news, and assets react, or an asset reacts in the exact opposite way you'd expect it to react. And the best example I can give you is, well, what could happen tomorrow? Tomorrow we have the PMI reports coming out, and I spoke ad nauseum about them today. But how could we see a news failure on the dollar and the PMIs? Well, if the PMIs come in really weak, a weak PMI report would entail a lower dollar, because lower PMIs mean lower growth prospects. Lower growth prospects mean lower yields on bonds. Lower yields on bonds mean lower currency, right? So dollar weakness. Leaving aside the yield equation for a minute, because again, I've already addressed the fact that we could see either way on yields. But what about the dollar? Could we see the news failure where you have a weak report on the PMIs and actually the dollar rally in front of a weak PMI report, having a news failure, and actually maybe popping its head back up 100? Again, this is just an idea. I mean, I wouldn't suggest maxing out on leverage, and going with it. Again, and this is really going against my own principle of not trying to pick the bottom. But I do see a possibility of possible news failure tomorrow. And it actually could be, it also bodes well with the idea that I've been pushing in my videos, that when we see this kind of correlation with the dollar, meaning lower dollar and higher yields, what usually follows is the exact opposite. All right. And again, going back in time, the yellow bars indicate what I just said, meaning lower dollar and higher yields. What follows that is dollar going up and yields going down. Okay. 2008 is a perfect example of this. Right here, from January till June of 2008, we actually saw the dollar go down, and right smack in the middle, we had Bear Stearns, a moment of great financial stress. Either way, we had lower dollar and higher yields. After that, we saw the exact opposite. Dollar started to surge, and yields started coming down. Could tomorrow be the a possible catalyst for that? Maybe. Again, this is just my. I'm putting this idea out there. Again, you don't have. I'm not suggesting you go. You just ape into it. You go max long 100 leverage. It's just something to think about on the dollar side of things. And just to answer, and this is just kind of to give some perspective potentially on the comment that we just saw just now, meaning what could move the dollar and yields. Again, just to summarize, my basic idea is that we will get the economy basically will force us to do something about the dollar and yields. That's the way I'm going about things. I think that tariffs are, I don't want to say old news, because they can definitely move things, and as we've seen. But again, I might be early, and I might simply be wrong. Early and wrong definitely rhyme. But who knows? We'll see how things evolve. We'll just see how things evolve. I'll finish off with gold. Today was an interesting day on gold. We actually pierced the 3,500 level on gold, but we reversed. Now, before I go any further, I'll just say what I say every time. Just because something went up a lot doesn't mean it is a good idea to short it. And just because something went down a lot isn't a great idea, isn't a good reason to long something. All right. Remember Peter Lynch. Just because something went down 40%, doesn't mean it can't go down another 40%. Okay. And just because something went up 50% doesn't mean it can't go up another 50% from here. Topping tails notwithstanding. Right. Now, what I will say is something that I've mentioned, I think, last week. Been making quite a few videos, so I don't remember when I said it. I'm pretty sure I said it last week. There is another comparison to be made with 2006 and 2008. Meaning, if you look at what happened in 2008, and what the lead up into 2008 we had, first move up, sideways action, kind of a breakout that led to a top. Same thing potentially happened here. We had the first move up, sideways action, breakout, which potentially occurred in February, nearly a year ago, potential top. And the significance of this top right here is that it actually occurred on the collapse of Bear Stearns. And the significance of that is that gold proceeded to underperform from that moment on, meaning as the recessionary environment took hold, gold started to falter. And it really passed the baton to bonds. All right. If you look at what happened to bonds, yes, we did see some, a rise in yields until June of 2008. But after that, you did have a few hiccups here and there. Mainly the collapse of Lehman Brothers right here, which is a topic of its own. I've spoken plenty of time about that. But ever since that, we really saw bonds really outperform and gold sell off by at least 34-35%. And why would that be? Well, in the lead up to a kerfuffle, as Diamond puts it, gold is usually one of the only winners. You're in an environment where stocks have already started to get beaten up to a certain extent. If you go and look back at the S&P 500, what the S&P 500 was doing in 2008, by the time Bear Stearns collapsed, right here, stocks had already gone down, if I'm not mistaken, about 20%. Now, a move that is not too dissimilar to what we saw this time around. And so in an environment where stocks are going down, bonds, yes, you did get a rally. But again, by the time, June came around, you were back at, 07 levels and 06 levels. It was nothing really noteworthy. The noteworthy part came later on, all right? And why does the gold usually pass the baton on to bonds? Well, because, again, gold is usually one of the only winners in the lead up to a kerfuffle. And it usually becomes a source of liquidity because it has, really been one of the only true winners. Now, again, is it popular to call the top? Absolutely not. I mean, I'm sure that, many of you potentially view the video, might have thought about owning gold, buying gold, maybe already long gold. And me saying that this might be the top for gold doesn't really sound too great. I get that. And I'll probably be wrong about the fact that this is the top for gold. And I'm not even really arguing for it to be the top. Again, just because it went up by a lot doesn't mean that it has to collapse immediately. But given the way I'm thinking about things, again, I go back to the first part of the video. I'm under the assumption, I'm working under the assumption that we are a little too confident about the state of the US economy. And sooner or later, doesn't have to be tomorrow, doesn't have to be next week, as the year evolves, I think we will have to reevaluate the state of the US economy. And if we actually get to that point, bonds will actually get to have the 15 minutes of fame, as they usually do. Bonds are boring for the simple reason that even in 2008, when the world was collapsing, they still found a way, all right, of selling off and rising on the 30-year by 65 basis points, all right, in the middle of a recession. And if that's not enough for you, and I talked about this many, many times, you should know this by now, but when Lehman Brothers collapsed, let me actually see what was this right here. The low was 419, so actually, I don't know, 402, right here. All right, really should have picked another different color. Right at the opening. So yeah, it was about 40 basis points, you know. And this was when Lehman Brothers was collapsing. Lehman Brothers, all right, possibly the worst part of the recession. So by the time you get this move right here, and this is really what everyone is looking for in bonds, but this comes later, all right? And, you know, we could definitely be in a different environment. We could be in an environment where it is doomsday, it is the end of the world, and the treasury is going to liquid. I'm you know, definitely could be. I'm just saying that in such extreme events, we're not really worrying about the stock market at that point. We're, you know, probably trying, you know, to learn how to fish or or grow crops at that point. So I hope we never get to that point. But again, you know, when it comes coming back to gold, this definitely looks like topping behavior. Again, it doesn't have to be topping behavior, but going back to, you know, the trade idea I spoke about before, a possible news failure on the dollar behaving as a possible catalyst for renewed bond strength and dollar strength that will not bode well with gold. Now, to give you, you know, I've given the bearish side on gold, I'll give you the bullish side on gold. The opposite. If tomorrow we get a strong PMI report, I've argued that potentially could raise the bar of uncertainty, because we would just have the Fed just standing still, right? Not hinting towards further rate cuts because, hey, the economy is looking fine. No reason to cut. In that case, Trump would get, you know, even more orange, even more angry. And the spat between Trump and Powell would continue at that point, which would raise the uncertainty around the dollar and bonds and everything like that. And in that case, gold could definitely, could be on its merry way up. You know, again, assets are stronger than my opinions. And that's a fact. So we'll see how things evolve. Hopefully I answered a comments question, and hopefully you enjoyed this video. And if you enjoyed it, like, subscribe, and I'll see you next time. Bye.